Thank you for your time today. We'll be concentrating on the cash flow statements and financial instruments for this particular interview. Would you like to introduce yourself?
My name is Marina, and I'm a professional accountant. I have over 30 years experience in finance, audit, and operations. And I currently sit on a listed company board as an independent non-executive director. I am also very active in the Malaysian Institute of Accountants and sit on several committees there, and also in ACCA, Global Forum for Governance, Risk and Performance. I was the past council member for Malaysian Institute of Accountants and the past chairperson of ACCA Malaysia Committee. So that is a very quick brief of my background.
Shall we start with the first question, Dato? Okay. So the first one is based on the cash flow statements, where we are saying that the accounting standards on the cash flow statements define cash equivalents as short-term, highly liquid investments that are readily convertible to known amounts of cash and subject to insignificant risk of changes in value. As a decision maker, what criteria do you apply to classify an investment as a cash equivalent?
So a cash equivalent is basically a liquid form that is can be easily converted into cash. Yeah. So cash is money in the form of currency. Things like commercial papers, treasury bills, and short-term government bonds with a maturity of 3 months or less would be something that's deemed as cash equivalent. So because they are liquid and they're not subject to material fluctuations in value, because cash is not valued. Yeah, there's no valuation for cash. Cash is just the value of the cash. So for an investment to qualify as a cash equivalent, it must be readily convertible to cash. Yeah. So and it should not have a value risk, because there's no valuation on that. So short-term papers, negotiable debt instruments, that are usually not secure, but backed by assets such as securities or loans issued by a corporation. So as long as it's less than 3 months, so it's very short term. Yeah.
Yes. Compared to current assets.
Assets which you cannot convert immediately. This is almost like cash, but it's in the form of other types of papers. Yes. Yeah.
Thank you. Okay. The next one is, could you explain the process in preparing the forecasted cash flow statements in terms of the budget setting process? Is the internal audit department involved in the preparation of the forecasted cash flows?
Okay. I start with the second question first.
Okay.
And the answer is no. Cash flow preparation, cash flow forecast, and cash flow budgeting is a management matter. Internal audit can come in to take a look at whether the cash flow has been prepared correctly in that sense. But normally internal audit looks at the test of controls. So there can be aspects of an audit review on how cash flows are being managed, the controls and management of cash flows, but not in the preparation itself. As an internal audit is defined, it is an independent process and they should not be involved in the preparation of the cash flow, but they can do a review on the internal controls over the management of the cash flow. So I hope that answers the second question. So now for management preparing the forecasted cash flow, the question was, what is the process involved? So there's two types of cash flow budgeting or forecasting. One is to look at the valuations and so on. The other one is your budgeting and managing your actual cash for your operations. So in terms of cash flow forecasting for budget setting purposes, what it is actually a very crucial part of your budgeting, because you can budget in terms of sales and profits and so on, but without the cash, your business is not going to survive. So you do need cash to manage the operations. So you need the cash to pay your bills. You can't have just paper profits. So having these accurate cash flow projections will help you see two things. One is to manage your working capital, to pay your day-to-day expenses, and the other one is for your future investment. So the forecast is two-pronged. One is managing your day-to-day. Second is managing your investments and your projects. So in that aspect, when you're looking at your cash flow forecast for your operations, it can be quite short-term. It's an annual cash flow forecast, or your forecast to if do you have enough to pay your loans. So it's the length of your loan or your borrowing period. If you have a 5-year term loan or a sukuk, you're looking at that period in managing how you pay off those liabilities. Now, the other one is the cash flow for your future investment. So when you're looking at investment, you've put money into the investment and you want to know how much cash is generated, how much your return comes from that investment. So that determining that period of your cash flow depends on the period that you want that investment to be realized. So that's number one, is determine the period of your cash flow and for what purpose you're doing this cash flow. Is it for your operations? Is it for your financing of your liabilities or financing of your investments? Or if you're doing for your organization, is all that. So you need to define those three main areas, for operations, for liabilities, and for your investments. So now you've defined the type of cash flow you require. Then you define the period tagged to each one of those, and then whatever that you also have in your budgeted P&L, right? That goes into the cash flow. So there is a difference between what is in your P&L and what is in your cash flow in terms of timing, right? Because you can forecast for cash for the sales, but if you give 60 days or 90 days credit period, then your timing of the cash coming in would be different from the time of your sales being booked in. So you need to be aware of the timing of the items in your P&L and your balance sheet as well. So for projects that is a longer term gestation period, it may not even be in the current year. So if you have those kind of cash flows, you have to manage it really, really well, because you put out the money now, but your return can be in 3 or 5 years. You need to be able to have that long-term cash flow planning. So you need to list out in a very basic. You need to list out what comes in and what goes out, at what time it comes in. Your incoming cash. Like I said, what you expect from your sales, what you expect from your receivables, your debtors. If you want to pay your suppliers, or you expect to get some refunds, so or grants or loans, that will be your cash flow inflow. And then when you're talking about outgoing payments, you're talking about again your suppliers. Tax payment can be quite high, lump sum. Your salaries, again, I mentioned investments, the layout for your investments, your rents, your utilities, and the loans and the interest paid. But you don't put in non-cash items that is in your P&L, like depreciation. So that's not a cash item. So it's basically what goes in and out of your bank account and the time of that. So as I mentioned, a good cash flow provides that clarity of what is your operating, your working capital, what is your investing, and what is your financing. When you do it that way, it becomes very clear in terms of the timing. So, and as a check and balance, you just think of it as your bank statement, what goes in and out. So that's in a nutshell, a very simplified view of what is in the cash flow. Number one, determine your period. Number two, determine the type of cash transaction, which is broken down into three things. The three things are your operating, your investing, and your financing. And then you look into the third item, what goes in and what goes out. So three things.
When you're looking at the cash flow for budgeting, are we looking at it as a bottom up or top down, or is a combination of the two? When you look at this,
I would say it's a combination. It's like I say, you need to first determine what is it that you want to have, what type of business or what type of projections you're looking for. Is it an operating? Is it investing, or is it your total company cash flow? Yeah. So that's bottom up, bottom down, right? But once you have done that bottom down, you do need to have that bottom up outlook, in putting in the detailed level. So, but first you need to have the top down strategy first. But if you do it from bottom up, just bottom up, you will not be able to strategize on the level of cash that you want to manage.
okay. All right. The next one is the forecasted cash flows are essential to a business as it indicates possible going concern issues. How would you deal with issues of going concern as a CFO?
So going concern means that the company needs to have resources to continue operating indefinitely. Yeah. So the cash flow provides the evidence that it has the ability to continue its operations. So another way to see is the ability to make enough money to stay afloat and avoid bankruptcy, right? So to ensure this ability to remain in business, there's ratios that you need to look into. Things like the current ratio, the debt ratio, and the net income to sales ratio. So it's not just the cash flow itself is good enough to say that, oh, I have a lot of money, so I am a going concern. But if that money is tied up, your liabilities are also a lot, you owe a lot of that, your gearing is very high. Just because you have a lot of money doesn't mean that that cash is sufficient to say that you're not bankrupt, because if you are in the net liability position, or your net income to sales, you are generating income, but net is a loss. The cost is more. It doesn't show that you do have the ability to operate or to make enough money to stay afloat just because you have cash. So so you may have very high net sales, but gross may be less. So you need to look at this trend analysis and work on the levers and see what are the ones that is actually generating this cash or this profitability. Okay, Shamala, can I just time out a bit?
Okay. Motivate students, I think. Okay. The last one is cash flow statements have implications for financial management. Could you explain how cash flow statements are used in financial management?
Okay. So this is different from cash flow forecast. Forecast is going forward and seeing how you want to manage your cash flow. Cash flow statements, is actually showing the movements of your cash, historical movement, So what it does is it measures how well a company manages its cash position, how it generates the cash. So that complements the balance sheet and the P&L and the income statement. So I love to look at, the first thing, when I look at an annual report of an organization, first thing I look at, did they make money? That's the income statement. Profit or not? That's number one. Number two, I will look at the balance sheet, right? Are they on a net asset position or net liability? That's number two. Number three, I look, are their business generating cash? That's cash flow from operations, at the top line. They may be cash flow positive if you just look at the balance sheet and they say, oh, last year they have 3 billion, this year they have 4 billion, or last year they had 300,000, this year 400,000. Oh, they make money higher. But if you look at the cash flow statement, where is that cash generated from? That additional 100,000, right? It could be they had a loan. And that's the reason why the cash is more. So looking at the cash flow statement will tell you where their cash is generated from. Is it from operations? Is it from loans? Or is it from debt collection, working capital changes? It's just that, it could be that their sales are low, but they have managed to collect all their debts from the past. And that's why they have more cash, So it tells a story. The cash flow actually tells the story of how the business is actually being managed, It gives details about their spending, whether they made more payments to creditors or, like I said, they collected a lot more money from their debtors, So this kind of transactions you won't see in the P&L, you won't see in the balance sheet, So it helps also to maintain this optimum cash balance. From there, you can know how much working capital or cash balance you need to maintain to manage your operations, to manage your financing, because in the cash flow statement, you've got cash coming from financing, you've got cash from investment and cash from operations, right? Again, remember the three things I said just now in the cash flow forecast: financing, investment, and working capital operations. Similarly, in your cash flow statement, you would have that. And you will know where is your positives and your negative inflows and outflows, right? So you can strike a balance, too much income from investing. My income from investing is not doing is not doing a lot of work, it's lazy. I need to move it out, so that I have more income from operations, managing that. So that's another thing in your cash flow. So it tells you how efficient you are in managing your cash flow. So that cash flow in those three categories needs to have just the right balances to come up to that optimal cash balance that you want. So it helps you to focus on how you need to generate your cash over and above the normal business operations. So in a way, if you pay less, if you pay your creditors on time, but the cost is less, you can see, you are your outflow is lesser in that way. So that and if you collect your receivables quicker, it helps your cash flow. So you can see those movements in your cash flow statement. So that's is a very useful tool in how you want to manage your finances. And a lot of people don't use this as their tool. So start looking at it and you can see that it's a very powerful tool. Yeah.
Okay, you mentioned something about arriving at the optimum cash position. How do you go about arriving at this optimum cash position?
So as I mentioned just now, if you do have investments, right, and you have income from investment, and a lot of the cash comes from your income from investment, but do you actually reinvest those funds, or you just leave it in your bank account earning very minimal, or you reinvest it back so it goes out that should be churning out more income from operations, because you're in the business of not just putting money in and sit in the bank account, right? You're in the business of generating income. So you need to show a lot more income or cash coming in from operations. So in that manner, you can see in your cash flow how efficient your cash is being used. Or a lot of your funds is just being used to pay off your interest and your loan repayments, right? And you know that you have to de-gear, reduce your gearing, because you are not investing more into your business to generate that income again. So all that you can see in your cash flow statement. Yeah.
Cash flow statement seems a very important component.
Oh, I always go. That's the one I spend the most. When I look at an annual report, like I say, how much profit, positive NTA. Then the next thing is you really read the cash flow statement. You can really see what they are doing in terms of the business from the cash flow statement. Yeah.
Yeah, because most, I think businesses just ignore this cash flow statement.
Yeah.
They
but
just,
you can, paper profit, because sometimes, it's a lot of depreciation, and with these accounting standards right now, right? Valuation, so they can be showing a lot of profit, but it's all fair value gain. There's no money in it, or they can show a lot of losses. Why? Impairment. But actually, the business is good, but they have huge impairments in their assets right now, for example. Or it could be that it is really bad because they have a lot of bad debts. Right?
yes.
So what is the one that is a non-cash movement, And you can see all that. The other way is you actually read the accounts, the notes to the accounts, but there's a lot, like 200 pages of reading all those notes, right? The quick reference guide is like an index, is your cash flow statement, because it's all there anyway, right? Your bad debts, your provision, your write-off. If they have a huge write-off, you can see that write-off there. It's not cash. They will have to put it in the adjustment up there, non-cash movement. And you can see, oh, this is a huge write-off. Oh, let me now check to the notes to the accounts. What is this write-off about? So it's a very quick reference guide. Cash flow first, then only read the notes. So you don't have to read the whole accounts. Read the cash flow first, and from there you check which notes you want to look at. The interesting bits. Yeah, it's very interesting. Yes.
We cannot go over to Dr. Jayanti's one because she's not well today. Okay, her questions are on the financial instruments. So the first question she asked is, the classification for financial instruments is based on business models and cash flow characteristics. In your experience, has there been a need to change the initial classification recognition over time to show better performance of the company? Is there problems faced when a reclassification is suggested?
Okay, this is my favorite, MFRS 9. Yeah, financial instruments. Reclassification is allowed only when there is a change in the business model in managing the financial assets. So that definition is, what is a change in business model, right? So we cannot willy-nilly decide, this I want to change this year and then next year and so on and so on. You can't. You have to have that justification. So and when you apply the reclassification, it's prospective, from the reclassification date going forward. So you can't restate what you have realized before, So that's number one. And changing the initial classification should not be the reason to show better performance. So the auditors are very smart on this one. The minute you want to say, I want to change my accounting policy on this, why? Is there a change in your business model? You are now a manufacturing. You're still manufacturing. So why you want to reclassify? Oh, because now I manufacture, cars, Now I manufacture computer equipment. You have to really justify, I don't think even that will carry weight, So justification on the reason, why you need to change that reclassification. And if it's just to show a better reflection of the nature of the financial instrument, then you need to show and justify that in reclassifying it in this new manner, it shows a better reclassification. So you cannot decide willy-nilly. And this one I would caution, what works for you now may work against you in the future. So my suggestion is stick to whatever classification that you have now. Don't do creative accounting. If that is what your entity requires now, you don't know the future. Follow the accounting standards. Don't be too smart. So but whatever is the definition of that financial instrument and it's best reflected in the balance sheet in that manner now, that should be it. And you have to think of it as a business requirement rather than as the current prevailing economic condition. Because if you look at the current economic condition, it will definitely work against you in the future. What goes up comes down.
Yes.
Yeah. So I strongly suggest against looking at reclassification for the purposes of a better performance of the company. If you want to look at reclassification, it's because your business model has changed and that financial instrument right now does not show a true reflection of what it should be in your accounts due to that change in the business. Yeah.
Right. The second question is FRS 9 replaces the incurred losses model in IFRS 139 with the expected credit losses model. Under the expected credit losses model, the loss allowance provision is for 12 months or lifetime based for forward-looking information. How does this pose issues for strategic planning?
Well, as the word says, it's strategic planning. So it should not pose a problem. So you do have that allowance. It gives you discipline in your strategic planning to ensure that the financial instruments are deeply scrutinized and you are aware of all your risks and you manage all your risks and you include all these scenarios in your financial forecasting. So you really truly have to know your business and to also be disciplined in your forecasting. You can't just be looking at the rosy world. You must be also looking at what can happen negatively. But yes, at times it can pose a problem because you can't crystal ball, like COVID-19, you can't. And so some assumptions do change drastically, even over a short period of time. Like COVID, I think a lot of accountants are very busy in forecasting and reforecasting the last 2 years. So that's why it is very important to have revisions of cash flow forecast, not just doing an annual cash flow, but when your organization is facing a lot of uncertainties, it needs to be done on a monthly basis even. Some even do, on a weekly basis on certain projects and so on and so forth. And you need to have various scenarios, not just one scenario for every cash flow. At the very minimum, you must have your best case, your base case, and your worst case at the minimum. And only then you are actually doing your strategic planning. So strategic planning does not mean that you have an annual cash flow forecast. It must be more than annual.
So how do you go about actually collecting this information for the strategic planning, especially dealing with this credit losses model?
So it is actually looking at those various scenarios, and also what are your key drivers for your business. So, for example, if you're in plantations, you look at oil palm prices. That's a key driver. If you are in manufacturing, maybe you want to look at fuel prices, right? So these are the things that swings your business. So if you are in investments, you want to look at the KLCI indexes, the interest rates. If you have high financing, you want to look at interest rates and how that is going to move during that. Remember when I was talking to you about cash flow, that period of review that you have, right? So if it's a 5-year cash flow, if your investment return, you're looking into what you're investing in is a 5-year cycle, you have to do a 5-year scenario planning. You can't just do the 1 year, because your return is going to be captured over 5 years. So those are the things that you need to look at. Your key drivers that drive your business, that needs to be in the cash flow, and those are the ones that you do the sensitivity and you do the changes.
Okay. Right. In your work experience, how do you treat intra-group loans between parent company and their subsidiaries when there is no expectation of repayment? What is the most favorable treatment?
Okay. Again, intra-group loans, there's also various types. To keep it simple, there's 2 types. Yeah. One is that you have written terms, right?
Mm-hmm.
So generally, this is like a financial instrument. So it will be treated like MFRS 9. Okay. So they are recognized at fair value or initial recognition based on the interest rates that you have, similar loans, and so on and so forth. Arm's length, right? So all requirements of MFRS 9 is in there. And when you consolidate, it gets knocked off, right? It's eliminated. But at entity or company level, it's a loan, and it has to be at arm's length. Bearing in mind, if it's not, you have transfer pricing issues as well, tax issues, right? So it has to be at arm's length. So why? Like I said, one is tax transfer pricing issues. Second is the valuation, because then if it's not at market, MFRS 9 kicks in, you still have to value it again at whatever market. So you are not going to gain anything from the financial perspective, right? Now, when there are no written terms, so it's not within the scope of MFRS 9 in terms of it as being a financial instrument. But then you need to look at it whether, in essence, is it funding or is it just normal interco? You pay for somebody's expenses, for the other company's expenses, or so transfer of funds and so on and so forth for operational needs. So if it's for operational funding, such as making expenses, and it's short term and it's paid, that's okay, yeah. But if you make this kind of payments on behalf of another intercompany with no repayment terms, and it becomes over a long period of time, yeah, it can be deemed as financing, yeah, as a long and even a long-term capital injection. So that is then in substance, that's the nature of how that balances is looked upon. It's a different measurement, and it may not be MFRS 9, but it can be deemed as a capital injection. And if it's not payable and so on, impairment requirements may apply, because depending on the nature of the debt or the company, the strength of the company. But if it's just, the company is strong, but you're just not making the payments, there would be questions on recoverability of debt as well. Why you're not making payments, the the debtor, the owing company, is healthy, is a going concern, but just not paying. It can be mismanagement as well, right? But then bad debt provisions then would kick in. So it really depends on the nature of that loan. So the substance of the loan will kick in. So we have to be careful. It could be a financial instrument still, even though you have nothing in writing. It can be a capital injection, yeah, or it can be just a current account debt, which is aged over 1 year, which you have to provide for. So in the substance of it, right? So we have to be careful. So where at times organizations give loans which is not written for capital injection purposes, then it will fall under the scope of MFRS 127. So we have to be careful on the substance of what that balances is for. Yeah.
It's quite interesting to know in practice.
Yeah, so
just that you have.
Yeah, right answer, right? So it's all back down to the substance. Yeah, and the relationship between the parent and the subsidiary. Yeah, so you can't get away by just not having anything in writing. It's the substance of what is in there. And even if you're paying the salaries of that subsidiary, yeah, and it's been going on for over a year with no sign of payment, it can be converted into a different type of balance, rather than current say, oh, you are actually providing a capital injection for the working capital of this company. So it's really back to the substance of that organization. Yeah.
So the management has to actually evaluate the purpose of the financial instrument. Yeah, okay.
That's correct, yes. Yeah.
So that seems to be a lot of management judgment.
That's correct. And at the end of the day, when the financial statements gets audited, they have to be able to justify with proper documentation on that that judgment that they have made, that management judgment, yes, and represent it to the auditors. So that in itself has to be very prudent. Yeah, when you make that kind of management judgments and representation to the auditors. Yeah.
Okay, all right. Thank you very much, Dato Merina, for your time. It was very informative, actually. I think the relationship between cash flow statements and financial instruments, because they do come into play in the cash flow statements as well, isn't it?
That's right. That's right. Yes.
Yes.
Always. Yeah.
Yeah. All right. Thank you very much.